Hello students, my name is Afreen Khan and today we are going to study the rest of the topics of macroeconomics chapter number 2, basic concepts of macroeconomics. Part 1 of this chapter is already up on channel. You can watch that video also, and in this part 2 video we are going to cover the topics that are final goods and intermediate goods, consumption and capital goods, gross investment, net investment and depreciation, NIT, that is net indirect tax, and the last NFIA, that is net factor income from abroad. And also I have tried to keep the video as short as possible, but still I feel the video become long, so I will provide you the timestamps in the description box. It will become easy for you students to track the topics, but still I recommend you to watch the full video for more understandability. And now let's start the video with the first topic.
Every single day I'm gonna make something great. That's my way. Every single day I'm gonna make.
So let's discuss first about final goods and intermediate goods. Final goods. It refers to those goods which are used either for consumption or for investment. It includes 2 points. First, goods purchased by a consumer household as they are meant for final consumption, like goods purchased by households. Second, goods purchased by firms for capital formation or investment, like machinery purchased by a firm. Next topic is intermediate goods. It refers to those goods which are used either for resale or for further production in a same year. It includes goods purchased for resale, like milk purchased by a dairy shop. Second, goods used up for further production, like milk used for making sweets. Third, goods used up in the same year are intermediate goods. I would like to add some points in this point, that it should always be remembered that the intermediate goods are used up in a same year, as this point explained, and if they remain more than a 1 year, then they are treated as final goods. Some important points to be remembered about intermediate goods: that they are generally purchased by one production unit from another production unit. That means intermediate goods remain within the production boundary. Okay. Second important point is they have derived demand, as their demand depends on the demand for final goods. Always, we'll take example after this important points. Um, Third important point to be remembered, that durable goods like truck, aircrafts, vehicles, etc., purchased by government for military purpose are included under the category of intermediate goods, as they are used up um to produce defensive services and not for the market sale. Okay. Fourth and last point to be remembered, that the value of intermediate good is merged with the value of final goods. Now, only final goods are included in national income. The intermediate goods are not included in national income, as they are already included in final goods. If their value is added again, then it will lead double counting. For example, of wheat and flour, only flour, which is an final good, is included in national income, as value of flour already included the value of wheat, that is an intermediate good. Note, it must be noted that the final good are neither resold nor used for a further transformation in a process of um, production. This is for final good. Now let's take an example of burger. Burger is a final good ready to be consumed. But the things are used in a preparation of burger, or the things used to make the burger are intermediate goods. Got it? Good. Now our next topic is about what is the difference between final goods and intermediate goods. I will explain the differentiation with basis, and also recommend you students always write the difference between with basis. It will help you to gain more marks and also help invigilators to check your answers properly. So, without further ado, let's start the topic. So, our topic is final goods versus intermediate goods. First base I have taken is meaning. Final good refers to those goods which are either used for consumption or for investment. On the other hand, intermediate good refers to those goods which are used either for resale or for further production in a same year. Next base is nature. If we talk about final goods, nature, they are included in both national and domestic income. But if we talk about intermediate goods, they are neither included in national income nor in domestic income. Next base is demand. In final goods, they have direct demand as they directly satisfy the wants, but intermediate goods have derived demand as their demand depends on the demand for final goods. Next base is value addition. In final goods, they are ready for use of their final users. That is, no value has to be added to final goods. But on the other hand, intermediate goods, they are not ready for use. That is, some value has to be added to intermediate goods. Next base is production boundary. In final goods, they have crossed the production boundary, but intermediate goods are still within the production boundary. Last base is example. In final goods, milk purchased by households for consumption is an example of final good. On the other hand, in intermediate goods, there is two examples. I have mentioned two examples. There are many more examples for intermediate goods. The first example is milk used in dairy shop for resale, coal used in factory for further production. And if you have any query, you can comment down below. I'll surely clear that. So our next topic is about production boundary. The concept of production boundary is very significant to understand the difference between intermediate and final goods. The production boundary is the line around the production sector. Now let's discuss how to classify the goods as intermediate goods and final goods. The difference between intermediate goods and final goods is made on the basis of use of product, not on the basis of product itself. A commodity can be an intermediate good as well as final good depending upon its nature of use. Got it? For example, sugar is an intermediate good when it is used by sweet shop, not a sugar shop, for making sweets. However, if it is used by a consumer, the same sugar, then it becomes a final good. Get it? Let's take one more example. See the diagram on the screen. There is an farmer. Let's denote farmer with A. A produces cotton worth rupees 2000 and sells it to B. Now B produces thread from that cotton worth rupees 3500, sorry, and sells it to C. Now C produces cloth from that thread which was made from cotton, and that cloth worth rupees 5000, and that C person sells it to the consumer. Now cloth is the final good which is sold to consumer. So students, here is a practice test for you. In this, you have to identify the following points which fall in the category of intermediate goods or final goods. There are 10 points to be identified, and I provide you 20 seconds to answer, and after that I will reveal the answers. So your time starts now. Time up, students. So here is the answers in front of you. You can check your answers. Uh, if your answer are wrong, you can, and you don't understand why you have answered wrong, you can comment down below. I'll surely clear your doubt and reply you soon. Our next topic is consumption goods and capital goods. Final goods can be classified into two groups, that are consumption and capital goods. So now we are going to discuss about consumption goods and capital good. Consumption goods refers to those goods which satisfy the wants of the consumer directly. For example, bread, butter, shirts, pens, televisions, furniture, etc. Consumption good can further be divided into the following categories. First, durable goods, second, semi durable goods, third, non durable goods, and fourth and last, services. Durable goods refers to those goods which can be used again and again over considerable period of time. For example, television, refrigerator, etc. Second subdivided group or category is semi-durable goods. Semi-durable goods which can be used for a limited period of time. These goods have lifespan of around 1 year, and for example, clothes, crockery, shoes, etc. Third category falling under consumption good is non-durable goods. Now these type of goods which are used up to in a single act of consumption, and these goods cannot be used more than a 1 year. That is, they lose their identity in single act of consumption. For example, milk, bread, food grains, food grains, sorry, paper, etc. And the last category falling under consumption goods are services. Services refers to non-material goods which directly satisfy the human wants. They are intangible activities, that is, they can neither be seen nor touched. For example, services of teacher, doctors, banks, etc. Now next topic is about capital goods. Capital goods refers to those final goods which help in production of other goods and services. For example, plant and machinery, equipments, etc. Few more points about capital goods: that first, they are used in future for productive purposes and have expected lifetime of several years. Second, they don't lose their identity in the production process, that is, they don't get merged in the process of production. And the third, last, they need repairs or replacement over time as they depreciate over a period of time. Now let's discuss how to classify goods as consumption good or capital good. There is no clear cut line of demarcation between or difference between consumption goods and capital goods. Same good can be consumption good and also a capital good. It depends on the ultimate use of the good. For example, machine purchased by a household is consumption good, whereas if it is purchased by a firm for use in a business, then it is a capital good. So our next topic is what is the difference between consumption goods and capital goods. So you have already know that I always prefer to do differentiation with basis. In this I have taken basis. So first base, as you can see, is the satisfaction of human wants. In consumption goods, these goods satisfy human wants directly, so such goods have direct demand. On the other hand, in capital goods, these goods satisfy human wants indirectly. So such goods have derived demand. Second base I have taken is the production capacity. In consumption goods, they do not promote production capacity. On the other hand, capital goods, they help in raising production capacity. Last base or difference is the expected life. As you have already know, as we have discussed also about consumption goods, the most of the consumption goods have limited expected life except durable goods. On the other hand, in capital goods, they have generally expected life of more than 1 year. So now we are going to study the comprehensive example of final goods and intermediate goods. So here is the comprehensive example. On the left hand side I have taken product, and in the center I have taken final goods. And in this there are two categories: consumption goods and capital goods. And on the right hand side, the intermediate goods. So first product we are going to talk about is car. If we talk about in a consumption goods, if car is purchased by household, then it is known as consumption good. And if the car is purchased by a taxi driver as taxi, or if purchased by a firm for use in a business, then it is known as a capital good, because it is an investment for the business. Now, if the car is purchased by a car dealer for resale, then it is intermediate good. Then it comes in a under the category of intermediate goods. Clear? Next product is cloth. So if this cloth is purchased by households, then it is known as consumption goods. And on the other hand, if this cloth is lying unsold with the trader at the end of the accounting year or capital formation, then it is known as capital good. Okay. And if this cloth is purchased by a tailor for making dresses, then it is known as an intermediate good. Or if this cloth is purchased by a garment shop for resale, then it also known as intermediate good. Clear? Okay. Next product is sugar. Same, if this sugar is purchased or used by household, then it comes under the category of consumption goods. On the other hand, if this sugar lying unsold with the trader at the end of the year, then it is known as capital good. On the other hand, if the sugar is used by a sweet shop for making sweets, then it's known as intermediate goods. Or we can say, if this sugar is purchased by a grocery shop for resale, then also is known as intermediate goods. Last example is service of doctor or lawyer. In consumption good, we have discussed the four subcategories. So one of them are is service. And if the service of a doctor or lawyer is used by household, then it is known as consumption good. Capital goods are not applicable on service, as they are consumable thing. And on the other hand, if the service of doctor or lawyer is used by enterprises, then it is known as intermediate good. So our next topic is gross investment, net investment, and depreciation. Investment or capital formation refers to addition to the capital stock of an economy. For example, construction of building, purchase of machinery, addition to inventories of goods, etc. Investment can be looked up into two forms. First, gross investment. Second, net investment. So first we are going to talk about gross investment. Gross investment is the addition to the stock. What? Addition to the stock of capital. before making allowance for depreciation. And in gross investment, capital stock consists of fixed assets and unsold stocks. Next, we are going to talk about net investment. Net investment is the actual addition. What? Actual addition made to the capital stock of an economy in a given period. Okay, so here is the formula for net investment. Net investment equals to gross investment minus depreciation. You can also derive gross investment formula from this formula also. Um, like gross investment equals to net investment plus depreciation. And I would like to add one more thing in this topic, that gross investment is the expenditure on purchase of fixed assets and unsold stocks during the accounting year. However, gross investment doesn't indicate the actual change in economy's stock of productive assets for a given year. During the production process, some amount of fixed assets is used up. This loss of fixed capital is depreciation. By subtracting depreciation from gross investment, we'll get net investment. So our next topic is about depreciation, or we can say consumption of fixed capital. Depreciation, also known as current replacement cost of fixed assets, and capital consumption allowance. It refers to a value of fixed assets due to normal wear and tear, passage of time, or expected obsolescence, or we can say change in technology. The concept of depreciation is very important to differentiate between gross value and the gross net investment. As we have discussed in the last slide, that we can also derive gross investment or gross values formula from net investment or net values formula. So here is the same formula which I told you in a previous topic, that gross is inclusive of depreciation, whereas net excludes it. It means gross value equals to net value plus depreciation. And depreciation of assets is mainly due to three reasons, as I told you. First, normal wear and tear. Second, passage of time. Third, expected obsolescence. So in wear and tear, continuous use of fixed assets in a production process decrease their productive capacity and value. And in passage of time, value of fixed asset also decreases with the passage of time, even if they are not being put to use in a business. Natural factors like rain, winds, weather, etc. contribute to fall in the value. And third, expected obsolescence. Value of fixed asset also decreases due to expected obsolescence, that is, loss in value due to change in technology or change in demand for goods and services. As you can see on the screen, that there is a diagram. It is for your help. You can take a screenshot, or you can just write somewhere, that it will help you to make a formula from gross to net and net to gross. Okay, so now we are going to study what is the difference between depreciation and capital loss. As I told you in my previous differentiations, that I always take basis to differentiate any terms. So in this I have also take basis to differentiate. So first base I have taken is meaning. So depreciation refers to fall in a value of fixed asset due to normal wear and tear, passage of time, or expected obsolescence. On the other hand, capital loss refers to loss in a value of fixed asset due to unforeseen obsolescence, natural calamities, thefts, assets, etc. Next base is provision for loss. In depreciation, provision is made for replacement of asset as it is an expected loss, but in loss, no such provision is made in case of capital loss as it is an unexpected loss. Third base is production process. In depreciation, it doesn't hamper the production process. Got it? And on the other hand, in capital loss, it hampers the production process. Okay? Our next topic is NIT, that is net indirect tax. In net indirect tax refers to the difference between indirect taxes and subsidies, and its formula is NIT equals to indirect taxes minus subsidies. Now we are going to study or discuss the 2 points. First, indirect taxes and subsidy. So, what is indirect taxes? It refers to those taxes which are imposed by the government on the production and sale of goods and services. Indirect taxes can be sales tax, excise duty, custom duty, etc. Also, indirect taxes increases the price of the product in market. If we take in an example, if cost of producing one set of speakers is rupees 500 and government imposes sales of 10%, then the price of the speaker will increase to rupees, yes, will increase to, yes, will increase to rupees 550 due to indirect taxes. Yes. Now we are going to discuss the next point, which is subsidies. Subsidies refers to the financial assistance given by the government to an enterprise on the production of a certain commodity. In India, LPG cylinder is sold as subsidized rates. They are often granted to promote exports or to encourage firms for setting up the industries in the background areas. And subsidies are opposite to indirect taxes as they reduce the market price of the commodity. Also, subsidies may also referred as economic assistance or financial assistance. If we take an example, the same example of speaker, if the government grant a subsidy of rupees 10 rupees, then the price of the speaker will fall to rupees 550 due to subsidies. In first case, in the case of indirect taxes, the cost of actual price or the cost of speaker is 500 rupees, and when government imposes sales tax on that speaker, then then the price of speaker will increase to rupees 550. But in a case of subsidy, if a government grant a subsidy of rupees 10, only rupees 10, not 10%, only rupees 10, then the price of speaker will fall to rupees, yes, 540. 10 rupees will get minus from the increased price. Get it? We have just used a formula which is as shown on the screen. I hope this topic is clear. If you have any query, you can comment down below. I will surely reply to your comment. Now we are going to discuss the topic factor cost versus market price. The concept of net indirect tax is very important to differentiate between factor cost and market price. Market price includes net indirect taxes, whereas factor cost excludes it. The concept of indirect taxes and the subsidies doesn't arise in two-sector economy, including households and firms. The concept is relevant in a three-sector and four-sector economy. So now we are going to discuss the what is factor cost and what is market price with an example. First, let's discuss FC, which is factor cost. Factor cost refers to amount paid to factors of production for their contribution in the production process. In a given example of 500 rupees is factor cost. We have taken the example in a previous topic, which was the if a cost of producing one set of speaker is 500 rupees, so here 500 rupees is the factor cost. Okay, and we'll continue this example after market price. So now we are going to discuss market price. Market price refers to the price at which product is actually sold in the market. In the example, in the given example, rupees 540 is the market price. It includes the net indirect taxes and excludes the subsidies. Here is the formula. Market price equals to factor cost plus indirect taxes. Indirect taxes minus subsidies, actually a net indirect tax formula. So you can also write market price formula like this: market price equals to factor cost plus indirect taxes. Okay, now let's discuss the example. As I said, factor cost in this example, factor cost of speakers is 500 rupees. After imposing 10% of sale, it has become the price will increase to rupees 550 due to indirect taxes. And when government applied or grant subsidy of 10 rupees on this speaker, then the actual price of the speaker is rupees 540. So 540 is of market price of this product. On your right hand side, there is a one diagram to formulate or formula of market price to factor income, or factor income or factor cost to market price. Okay, I'll suggest you to take a screenshot or write it somewhere so that it will easy for you when you will write or solve the numericals, then it will help you. So write it somewhere, make a notes, so it will help you in future. If you have any query in this topic, you can comment down below. I'll surely clear your doubt. So now let's discuss the last topic of the chapter or the video, which is net factor income from abroad, also known as NFIA. So NFIA refers to the difference between factor income earned from rest of the world and factor income paid to rest of the world. Here is the formula of NFIA, that is NFIA equals to factor income earned from abroad minus factor income paid to abroad. Repeat with me this formula. NFIA equals to factor income earned from abroad minus factor income paid to abroad. This is the formula of NFIA. Here is the two components in this formula. Let's discuss these two components. First component is factor income from abroad. In this, income is earned by a normal resident of a country from the rest of the world in the form of wages and salaries, rent, interest, dividend, and retained earning. Next component of this formula is factor income paid to abroad. In this, factor income paid to the normal resident of other countries for their factor services within the economic territory. Here is another formula of NFIA. This formula will help you while solving the numericals in national income chapter. And the formula is NFIA, or net factor income from abroad, equals to net compensation of employees plus net income from property and entrepreneurship plus net retained earning. Repeat with me this formula. It's very important to learn this formula, so repeat with me. NFIA equals to net compensation of employees plus net income from property and entrepreneurship plus net retained earnings. Don't worry, we will discuss these components at the end of the video so that you will get everything about NFIA. And still you have any query about the topic, you can comment down below. I'll surely reply or clear your doubts. So now let's discuss what can be the significance of NFIA, or what are the significance of NFIA. NFIA is significant to differentiate between domestic income and national income. In a practical estimates or on a numerical point of view, domestic income is estimated first, then national income is derived from domestic income. As you can see, there is a formula on a screen of national income. So what that formula says, national income equals to domestic income plus factor income from abroad minus factor income to abroad. So what's the difference between these two terms, factor income from abroad and factor income to abroad? The difference of factor income from abroad and factor income to abroad is termed as net factor income from abroad, or popularly abbreviated as NFIA. So, national income equals to domestic income plus NFIA. On your right hand side, there is a diagram of which says national, domestic, or net factor income from abroad minus net factor income from abroad. This is the diagram which help you to formulate the formulas of national income to domestic income or domestic income to national income. Let's say we have to find out the formula of domestic income. What we'll do, see that diagram. By this diagram, we can clearly see we have to minus the NFIA to find out the domestic income. What will be the formula of domestic income? Is national income minus NFIA equals to domestic income. Next, NFIA can be positive, negative, or zero. When NFIA is positive, income earned from abroad is more than income paid to abroad. I'm repeating again this point. When NFIA is positive, income earned from abroad is more than income paid to abroad. And when NFIA is negative, income earned from abroad is less than income paid to abroad. Again, I am repeating this point. When NFIA is negative, income earned from abroad is less than income paid to abroad. And when NFIA is zero, what I am saying, when NFIA is zero, income earned from abroad is equal to income paid to abroad. Again, I am repeating these 3 points to make you understand more. When NFIA is positive, income earned from abroad is more than what? Is more than income paid to abroad. Next, NFIA is when negative, income earned from abroad is less than what? Is less than income paid to abroad. And when NFIA is zero, income earned from abroad is equal to income paid to abroad. Summary of these 3 points is when NFIA is positive, then there is a case, then this is the case of more than. When NFIA is negative, then this is a case of less than. When NFIA is zero, then it is a case of equal to. And I would like to add one more thing in this, that NFIA is zero in a closed economy. As such, economy doesn't deal with the rest of the world. So now we are going to study or discuss the components of NFIA. As you remember, the formula of NFIA, the big one formula which I told you is very important to be learned. So that formula is NFIA equals to net compensation of employees plus net income from property and entrepreneurship plus net retained earning. So these are the three main components of NFIA. So let's discuss. First component is net compensation to employees. It refers to difference between income from work received by resident workers living or employed abroad for less than a 1 year and similar payments made to non-resident workers staying or employed within a domestic territory of a country for less than 1 year. Next main component of NFIA is net income from property and entrepreneurship. It refers to difference between income from property and entrepreneurship in a form of rent, interest, and dividend received by a resident of a country and similar payments made to the non-residents. Third and last main component of NFIA is net retained earning. It refers to a difference between retained earnings of resident companies located abroad and retained earnings of non-resident companies located within a domestic territory of a country. I hope this topic is clear. These components are clear to you. If you have any query, you can comment down below. I'll surely reply. So now it's time to revise few important terms of the chapter. Here are terms which are important and to be remembered or to be revised. So I have mentioned these terms. Please pause the video and read these terms one by one. I'm not going to waste your time by reading by myself. So yeah, if you like the video, please press the like button and also comment down below whatever you think must be improved or liked. Also share the video with your friends and subscribe to our channel and press the notification bell and make it gray so that you will be notified whenever we upload a new video. Till then, bye bye.